Insurance companies use data to raise premiums. Ever wondered why your insurance premiums keep going up? In today's video, we'll dive into how insurance companies use data to raise your premiums. Stay tuned to learn the 15 ways data is changing the way you pay for insurance. 1. Fraud detection. Insurance fraud can take many forms, from exaggerated claims to outright falsifications. Insurers use advanced data analytics and machine learning to detect fraud patterns by analyzing claims data, customer behavior, and external factors. Fraud detection systems flag suspicious claims for further investigation. Fraud leads to financial losses for insurers. To recover those losses, insurers often raise premiums for customers in high-risk categories or across the board to account for the increased cost of fraud detection and the risk of fraudulent claims. 2. Customer segmentation. Customer segmentation categorizes policyholders into groups based on shared characteristics like age, location, income, claims history, and lifestyle. Advanced data models enable insurers to assess risk more accurately and set more appropriate pricing for each segment. Higher risk segments, such as young drivers, people with a history of claims, or those living in high crime or disaster-prone areas, are charged higher premiums to reflect the elevated risk they present. This segmentation allows insurers to raise premiums for specific customer groups based on risk. 3. Telematics and IoT. Telematics in auto insurance and Internet of Things devices collect real-time data on policyholders' behavior. For example, telematics devices track driving speed, braking habits, and time of day, while smart home devices monitor for fire, water leaks, or security threats. High-risk behaviors like speeding or poor driving habits trigger higher premiums for those customers. Similarly, IoT sensors may reveal issues like frequent water leaks or inadequate home security, prompting insurers to increase premiums to cover the additional risk. 4. Predictive analytics. Predictive analytics uses vast amounts of historical and real-time data to anticipate future claims. By evaluating factors like weather patterns, demographic data, and economic indicators, insurers can estimate the likelihood of specific events such as natural disasters, medical claims, or property damage. Predictive models that forecast higher probabilities of events like hurricanes, floods, or wildfires in certain regions often lead insurers to raise premiums in those areas. If predictive analytics indicates that a person is likely to develop a chronic health condition or requires frequent medical treatments, health insurance premiums may rise to reflect that future risk. The insurer is essentially preparing for anticipated claims, and those predictions influence the premiums that are set for different risk categories. Moreover, with the increasing sophistication of predictive models, insurers can personalize risk forecasts for individual policyholders, allowing for more dynamic pricing and adjustments based on future risk assessments. 5. Claims history analysis. A policyholder's past claims history is one of the most direct indicators of future risk. Insurers evaluate the frequency, type, and cost of claims filed by a customer to assess how much risk they represent. Frequent claimants, or those who have filed high-value claims, are typically deemed higher risk. Frequent claims, whether for minor or major incidents, indicate to insurers that a customer is more likely to file additional claims in the future. For instance, someone who has filed multiple auto insurance claims in a short period is considered a higher risk for future accidents, prompting an increase in premiums. Even if claims were small, their frequency could signal a pattern of risk behavior, which results in higher premiums to cover the anticipated costs. Additionally, the severity of past claims plays a role in premium increases. If a policyholder's previous claims were costly, for example, extensive damage in an accident or a major medical procedure, insurers may raise premiums significantly to recover those potential losses. 6. Lifetime value, LTV. Insurance companies calculate the lifetime value, LTV, of a customer, which estimates how much revenue the insurer will generate from a policyholder over the duration of their relationship. LTV incorporates claims history, retention, likelihood, and profitability. If an insurer predicts that a customer will be a high-value client, they may increase the premium to maximize profit. Conversely, if a customer has a low LTV due to a history of claims or high churn risk, the insurer may raise the premium to compensate for those potential losses. 7. Personalized product. Insurers now use data to create personalized policies that are better suited to individual risk profiles. These policies can include customized coverage limits, deductibles, and added benefits that reflect each customer's unique risk. A highly personalized policy may include higher coverage limits, additional riders, repairs, or more comprehensive coverage, all of which increase the premium. Personalized products help insurers charge more accurately for the level of risk associated with an individual. 8. Health data monitoring. With the rise of health tracking devices like Fitbit, Apple Watch, and other wearables, insurers can collect data about a policyholder's physical activity, sleep patterns, and health metrics. This data helps insurers evaluate individual health risks. If a policyholder shows signs of unhealthy behavior, such as low activity levels or medical conditions, their premiums may increase to account for the higher likelihood of future medical claims. 9. Social media insights. Insurers are increasingly turning to social media and public records to build a fuller picture of a customer's lifestyle and risk profile. Publicly available data such as job history, lifestyle choices, or even posts about risky activities can provide insight into a person's risk. If social media reveals high-risk behaviors, such as frequent travel to dangerous areas, risky hobbies, for example skydiving, or a luxurious lifestyle in. 10. Loss ratio analysis. The loss ratio is the ratio of claims paid out to premiums collected. It is a key performance indicator for insurance companies. If the loss ratio becomes too high, insurers may raise premiums to cover their costs and maintain profitability. If insurers are paying out more in claims than they are collecting in premiums, a high loss ratio, they will often raise premiums for all customers or for high-risk groups to balance their books and remain financially stable. 11. Process automation. Automation tools, including artificial intelligence, AI, and robotic process automation, RPA, help insurers streamline operations like claims processing, underwriting, and customer service. Automation reduces operational costs and increases efficiency. While automation can reduce operational costs in the long run, it may also enable insurers to fine-tune their pricing models based on more detailed data. In some cases, automation may lead to higher premiums. 12. Market conditions. Insurance companies also use external market data to adjust premiums. This includes analyzing factors such as inflation, reinsurance costs, and shifts in the insurance market. Economic trends can directly influence pricing models. In times of economic uncertainty or when reinsurance costs increase, insurers often raise premiums to account for rising costs in the broader market. 13. Regulatory changes. The insurance industry is highly regulated, and changes in government policy or legislation can have a significant impact on premiums. New regulations often impose additional requirements, such as higher coverage limits or new types of coverage. When new laws or regulations increase the cost of providing coverage, such as higher minimum liability limits, insurers may raise premiums to comply with these legal changes. 14. Competitive pricing. Insurers regularly analyze competitors' pricing strategies to ensure they remain competitive in the marketplace. By comparing premiums, coverage options, and claims handling, insurers adjust their rates based on what other companies are doing. If competitors raise premiums due to increasing claims or economic pressures, insurers may follow suit to maintain profitability. Additionally, if an insurer wants to position itself as a market leader, it might raise premiums for certain products to reflect higher quality services or coverage. 15. Catastrophic event risk. Insurers use data to assess the likelihood of catastrophic events such as earthquakes, floods, or wildfires. These risks are often hard to predict, but advanced analytics can help insurers understand the probability of large-scale events. Thank you so much for stopping by to watch Juno. If you enjoyed this video, don't forget to like, comment, and share it with your friends.